Alan Iney, a senior specialist in creativity and scenario, says the following in a TED Talk called Reigniting Creativity in Business.
It's a paradox. Creativity has never been more essential to competitiveness, but the critical approach to practical creativity is often lacking. The key to adapting to an ever-changing world is doubt. This is not a popular thing to say. Leaders are not expected to show any doubt, but let that go. Doubt that the way you have always done things will always work. Doubt that the mental models you are using to look at the world are the only possible way to look at it. Doubt is about releasing the constraints, removing the blinders, and understanding the assumptions that get us through each day. It means opening our minds and being willing to find useful new boxes for whatever the problem is that we are trying to address.
There are many examples of the lack of timely doubt throughout history. Henry Ford was an amazing innovator. He started with the Model A, and by the time he had made his way to the Model T Ford, it had become a status symbol in the urban environment. But as the world kept turning, General Motors came up with higher and lower end cars, and cars in different colors. But Henry Ford famously said, "My customers can have any color car they want, as long as it is black." He failed to adapt, to change his boxes in time. He failed to doubt, and his company nearly went bankrupt. More interestingly though, when the Model T, this status symbol of the urban environment, spread to the countryside, farmers would buy one, take out the back row of seats, and use it to haul tools and hay and produce. And it took 19 years of farmers and merchandisers manually modifying the Model T to carry a load for the first pickup truck to be manufactured. 19 years of Ford refusing to doubt their boxes, refusing to change their mental model for the car being a status symbol in the urban environment only, and refusing to doubt that there was something more they could offer some of their customers. Enter hedge fund regulation. The first South African hedge fund was launched in 1997, and now, 20 years later, around 150 funds are available. In 2015, the Financial Services Board, or FSB, announced that hedge funds were allowed to register to be regulated under the Collective Investment Schemes Control Act. As part of this process, each individual fund had to prove their compliance to strict risk requirements set up by the FSB in order to become unit trust funds. The governance of hedge funds under the Collective Investment Schemes Control Act lifted the constraint that previously resulted in access only to pension funds and high net worth individuals. It now offers the same structural benefit as traditional unit trust funds, but with even stricter investment oversight applied to the hedge fund category to further protect investors. The status quo for many individual investors is still to invest in traditional unit trust funds only. So let us doubt for a moment that traditional unit trust funds are the only way to create wealth. Let us examine the current investment assumptions compared to that of the new equity hedge fund unit trust in order to possibly create a useful new box. When one invests in an equity unit trust fund, one becomes a beneficiary of the changes in share price of a certain combination of companies listed on the Johannesburg Stock Exchange. The investment assumption is that the specific combination of shares will increase in value over time. But there is more to this assumption. It is widely accepted that the changes to the share price of a company is loosely divided into two parts. Firstly, it has a sensitivity to general market movements that affect all companies operating in the same economy and are caused by factors like GDP growth, inflation, interest rates, and sentiment. And then secondly, the unique influence of the particular company's management team that can result in an additional improvement or destruction of profitability. This can be done through cost cutting, mergers, an innovative new product, or on the negative side, overspending, faulty products, or under-providing for certain contingencies. The change in a traditional portfolio investing equally in two shares, A and B, will therefore be sensitive to the general market change and as 50% of management team A's value and 50% of management team B's value. it will be most beneficial to this traditional portfolio if the market increases in value due to economic forces and both the management teams create additional value in their businesses. It is also clear that if you hold a view that a specific management team will destroy value, in other words, if for instance Team B's value will be negative, the most beneficial way to express this view in the traditional unit trust fund is not to invest in the share at all. In 1948, A.W. Jones was desperate to safeguard his long-term share portfolio from a bear market by introducing additional sources of independent returns. His key insight was that the deep fundamental work he performed to buy stocks also identified stocks expected to decrease in value, but that the traditional way of investing only allowed him to take advantage of the positive insight, not the negative one, even though his conviction on both views were equally high. He therefore developed a method of investing that delivered to the user a directly inverse result to that of the specific share price it referenced. This investment innovation is now referred to as shorting, and as financial markets became more active and sophisticated, shorting has become mainstream. The method not only enabled the implementation of his full investment insights, but also shielded his investments from the risk associated with overall market movement. But let us look closer at how this works. We are back at companies A and B. The change in share price is still reliant on the general market change plus the unique value the management teams can add. This time around, however, the investor is of the view that the management team A will add value while management team B will destroy value. In his hedge fund portfolio, he therefore invests in the shares of company A and shorts the shares of company B. Because the mechanism of shorting delivers an inverse return to that of the reference share, the change in the portfolio is now the change in share price A minus the change in share price B. And by again expanding the changes of each share price into its two components, the common market component is now cancelled out, so that the change of the total portfolio comes to management team A's value minus management team B's value. If the investor is correct and management team A was to create, say, R2 of value for investors and management team B was to destroy R2 of value, the portfolio would gain R4. The hedge fund investor was successfully able to implement a view that one company would create value and a second will destroy value. And note that the portfolio has been left immune to the changes in the general market. Hedge funds are not a substitute for traditional unit trust portfolios like the pickup truck was for the Model T in the countryside. Rather, I believe that hedge funds are a new, regulated addition that once properly considered establishes itself as an inseparable complement to traditional equity investing, the third leg of the tripod stool. Neither one of these two regulated products can produce the sources of return the other can. The traditional equity unit trust fund draws from market exposure and the ability to select companies that will show improved profitability. The second fund can eliminate market exposure and effectively implement a view that a company is set to destroy value. By combining both the skill set of traditional and hedge fund unit trust, all three sources of return identified through typical fundamental company research will be harvested to create a more robust balance of independent returns. Take the time to deliberately test the assumptions and constraints you are using to interpret the opportunities around you in an ever-evolving world. With new information at hand, challenge the way you think about investing, your company, your customers, and your competitors, and allow yourself to include many useful new boxes. Despite the simplification of theory presented in this talk, there are many different styles and strategies of hedge funds born out of investment innovation, each with a different niche and aiming at different outcomes. We construct hedge fund portfolios by combining different strategies. We focus on examining, combining, monitoring and rebalancing a portfolio of hedge funds for a specific outcome. If you have any questions on how the correct combination of hedge funds can add a valuable new source of return to your client's portfolio, please contact us.